So good afternoon, all respected delegates of this today's program. And of course, I welcome today's speaker, C.A. Dhinal Saji, past Central Council member, the Institute of Chartered Accountants of India, the Vice Chairman, very respected, my elder brother, C.A. Rajendra Kumar PG, and of course, today's moderator of the program, C.A. Vaibhav Jindal ji, and most importantly, the Secretary of the committee, Madam Rita S.G., who has done a lot of efforts for today's this webinar. So, friends, the today's webinar is on the taxation aspects of the companies under IBC. So, as this is my a sort of saying always that there are two types of companies across the world. One who are performing good, that is the one side. The other side, one who are not performing good, who are ill and who are under, somehow in this restructuring IBC or whatever you can say in other form of, re-innovation of the companies. So, friends, today's webinar that is on uh, taxation aspects of the companies under IBC and no other than the very learned speaker and of course a person who has a lot of experience in the field. C.A. Dhinal Saji is with us to deliver and to uh, mentor us on the aspects as this is very important aspect to understand because 2 days back only I had a discussion with one of the lawyer for my one of company which is under IBC. So a lot of complications are there when you practically discuss the practical issues with respect to the companies under IBC because certain provisions under the Income Tax Act which are meant to have the practical application on the IBC, whether that have been followed or not, whether the department has been taken in the COC or not, and how the dues are to be settled, whether resolution plan consists of some provision for the taxation aspects or not. So these are the practical aspects to be discussed and to be understood by any person. Friends, it's indeed a pleasure and privilege to me to welcome you all in today's program. I am traveling, so I am not able to, give you introduction of our respected speaker and of course the moderator. And I have given this responsibility to my respected vice chairman of the committee, C.A. Rajendra Kumar PZ, to kindly take the session ahead. I am thankful to Rita Madam for organizing such wonderful program in the interest of the members at large. So once again, I welcome you all from core of my heart on my own behalf and on behalf of CIBC. One more information, friends, that I would like to share with you. The Committee on Insolvency and Bankruptcy Code is going to organize one international conference in coming time. The entire itinerary will be shared with you all very soon. And before that, I just request you all, since this is international conference to be held outside India, first time in the history of ICI, I'll request each one of you to kindly just make it note in, and block your diary. In the next week, we will announce the program. So over to Rajendra Bhai for furtherance of the program. Thank you, one and all.
Thank you, my esteemed chairman of this very important committee of ICAI, CA Gyan Chandra Misra ji, my very good friend, my former council colleague, and a person to whom I have a lot of love and affection to share, Dhinal Bhai, that's how I call him. Vaibhav Jindal ji, who is going to moderate this. Of course, our office Rita is there, and others who are there. Nisarg, Nisarg is doing the technical support. Friends, you just heard the chairman speaking. In fact, we have on the screen CA Dhinal Shah, who is also an advocate. Currently, he is a practicing advocate. In fact, I have not spent many years with Dhinal, nor do I know him from his younger school days or college days. In fact, we never used to meet regularly. But then there are some people who leave a great impression on you, even if they are with you for few years or few hours. So myself and Dinal Bhai joined the council in 2010-13. And let me tell you, friends, as an intellectual, as well as a great human being, the qualities of head and heart I did find in my very dear friend Dinal Bhai. In fact, there was one incident in the council which I can very nicely remember today. It was in the year 2013, somewhere January or February, meeting was going on, and with a very heavy heart, I had to leave the council. I just went outside, and Dinal Bhai followed me and ensured that I am brought back into the council hall and made seated. Like, that is the quality of this great person. Now, it is often said that the best minds tend to lose objectivity in their pursuit of excellence. But Dinal Bhai is an exception. He never tends to lose objectivity. He's a person who is fair. He's a person who takes a stand. He's a person who will always be willing to serve. I see AI willing to serve his clients and all of us. And today, being a very working day, he's here with us. I can speak hours together, but then I know time is a constraint. Welcome, Dinal Bhai. So nice to see you again with us today. Jindalji, I think you have a long task today to be with Dinal Bhai and ensure that all of us are taken through these sessions. Thank you very much.
Thank you so much, Rajendra Kumar sir, for your opening remarks and introduce formally, but still there is this formality. So I would do that to introduce Dinal sir and Vaibhav Jindal-ji. With your permission, I'm going ahead. CA Dinal Shahji is a practicing advocate, as told by our Vice Chairman sir. He's also a chartered accountant by qualification and has more than 30 years of experience in advising clients on taxation, exchange control, and insolvency and corporate laws. He has been extensively involved in advising Indian corporate and multinationals on issues relating to double tax treaties, due diligence, transfer pricing, foreign tax systems implications, corporate tax, accounting standards, and so on. He's an executive committee member of International Fiscal Association and secretary of ITIT Bar Association, Ahmedabad. As we all know, he was a central council member of ICI and he was director of IPA and RVO formed by ICI. And he was chairman of Direct Tax Committee of Gujarat Chamber of Commerce and Industries. He's visiting faculty at IIM on professional topics. He has addressed various conferences and presented papers. And he is also a regular contributor of articles to Institute and other professional journals. He has also co-authored a book. Welcome to you, sir. And now I would like to introduce CA Vaibhav Jindal-ji. He began his earlier stint with a multinational accounting firm in the assurance and taxation line of services. Later, he ventured into insolvency laws. He has been part of the team that handled amongst top 12 IBC cases in this country. With this, sir, with the Vice Chairman's permission, we hand over the session to the moderator, Vaibhav Jindal-ji, so that he can hand over the session to Dinal Shah sir for his deliberations. Over to you, Vaibhav-ji.
Yeah, thank you, Rita-ji. At the outset, I would like to thank the committee on IBC, ICM, CA Rajendra Kumar-ji for organizing this webinar on a very important topic, that is taxation aspects on companies under IBC. So we have an overwhelming participation today. That itself shows how much importance this topic carries for the professionals that are associated with IBC. Eagerly waiting for CA Dinal Shahji to enlighten us with his wisdom. I welcome you, sir, and I thank you. Thanks a lot for joining us here today. And lastly, I would also like to extend my warm gratitude to the committee for having me over here.
So over to Dinal Shah, sir.
Thank you. So, Ranjan Mishra ji, the chairman of the committee, my good friend Rajendra Kumar ji, vice chairman, Rita ma'am, Vaibhav, and seniors in the profession and dear friends. Thank you, RK ji. I can only tell you, RK, about your kind words and memories of experience working with you. And I know the passion at which you had worked in the past in the council, and now you are working for the profession, and particularly on your indirect tax journey, from VAT to service tax to GST. And now it is almost 5 years after introduction of the GST. So it has been a good experience and memories working with all of you in the past. Let me touch upon few minutes to summarize the IBC law, and then go to a taxation laws. We are all aware about section 7, 9, 10 of the IBC for initiation of corporate insolvency resolution process called CIRP by these operational creditors, by the financial creditors, and by the company itself. Every application which is admitted by the adjudicating authority undergoes the CIRP process. And as a part of the CIRP process, the resolution plan is submitted by a potential resolution applicant. And that resolution plan, subject to approval by the COC, evaluation by the IP, it is approved under section 30 of the IBC Act, read with section 31, by the adjudicating authority. And if for any reason there is no plan which is submitted by a resolution applicant, or if the plan is not approved by the COC, or the plan is not approved by the adjudicating authority, then company goes into liquidation. The law, when initially it was implemented from December 16, the liquidation was more meant like a sale of an assets on a piecemeal basis. So I sell individual plant and machinery, I sell individual inventory, I go and sell individual building, land, etc. And then ultimately company is liquidated by operation of law. But going by the experience and in the spirit of the IBC law of going concern, the regulators rightly amended the law to say that even under liquidation, you can sell the business on a going concern. And therefore, the going concern principle is now relevant both for CIRP and for liquidation. And therefore, when you look at the law, both from the Income Tax Act or from a GST Act perspective, the going concern principle becomes relevant. In between, in 2018-19, the law also got amended that as a part of the plan, the resolution applicant can propose a restructuring of a business, which is a corporate debtor like amalgamation, merger, etc., or a demerger, as a part of the scheme, for the purpose of, again, achieving the going concern principle and maximizing the value of the assets. The going concern and maximization of the value of assets are two foundations of this entire IBC. And those you are all practicing IBC, my request to you is please go back to Banking Law Reforms Committee report and a Swiss Carbon judgment to understand the implications or the niceties of law, because substantial paras of the Banking Law Reforms Committee has been reproduced by Supreme Court over a period of time. And this is one law where the government and the judiciary both has been very, very proactive in deciding certain issues so that ultimately the spirit of the law is achieved. Let me go back to Income Tax Act. There are 3 amendments, or I would put it 4 amendments, which are made under the Income Tax Act in relation to the Insolvency Bankruptcy Code. The first amendment was in relation to Section 140, where the IP, by his digital signature, can file the income tax return, and he has been designated as a principal officer for the purpose of filing the tax return. Now, this was required because if IP is responsible as a de facto management control of the corporate data, when in MCA the name changes from a suspended management to the IRP, then the income tax return also should be filed in the name by the signature of the insolvency professional, and where a law has been specifically amended under Section 140. Before 2 years, Section 156 capital A was introduced, and where the law specifically said that after the approval of the resolution plan, the income tax dues which are classified as an operational dues, now whether it is secured, unsecured, based on rainbow judgment, we will look at a slightly later point of time. So when income tax dues are treated as an operational creditors, then, and if the resolution applicant proposes a part payment towards an income tax liability being an operational creditor, and the balance demand needs to be deleted from the system, for which Section 156 capital A has been specifically introduced, that after the approval of the resolution plan and after the application is made by the resolution applicant or the successful resolution applicant to the income tax department, the demands will be deleted or removed from the system to the extent of which the liability got extinguished by operation of law and approval of a resolution plan. Then Section 79. You are all aware that Section 79 is applicable when there is a change in management of a unlisted private company, and where if there is a change in management by more than 51%, then the losses of the earlier years are not allowed to be carried forward by virtue of change in management. But this has been exception in case of companies under CIRP, where Section 79(2) Clause C provides that this principle will not apply if the companies are under CIRP and where the resolution plan is approved by the adjudicating authority. The another amendment which was made in Section 178, subsection 6, that the liquidation provisions will not be applicable in case of companies under IBC, and therefore it would govern by IBC law and not by the Income Tax Act as far as Section 178 is concerned. This provision also has some challenge in the case of Om Prakash Agrawal of Enclave judgment in relation to TDS, which again we will look at a slightly later point of time. The other amendment was made in Section 170 capital A, where after the amalgamation, after the demerger, or after the order of the adjudicating authority, if there is a business restructuring by virtue of the approval of a resolution plan and proposal by the successful resolution applicant, then the successor company is required to file a modified return within 6 months from the date of order, which is received by the applicant to the income tax department under the modified tax return for the purpose of giving effect to the resolution plan, which is approved by the adjudicating authority in case of a business restructuring. These all, Section 170A basically was inserted to overcome the Supreme Court judgment of Dalmia Power, where the Supreme Court said in case of a demerger, there is a principles of impossibility of performance. And therefore, even if the merger or demerger is approved at a subsequent date, but it is effective from an earlier date, based on Marshall and Sons judgment, I need to file the revised return If the time for filing the revised return has expired, that was a practical challenge. So to overcome this practical challenge in the technology world, Section 170 capital A has been introduced to take care of this business restructuring situation, including in case of the resolution plan approved by the adjudicating authority. Now, let me go back to a specific certain challenges which I believe are relevant for the discussion on today's session. Whenever there is a change in management from a present corporate debtor management or a shareholders to the shareholders or the proposed resolution applicant, the law under Section 56(2)(10) provides that the shares has to be transferred at a fair value defined under Rule 11 UA. One of the challenge of Rule 11 UA when you go to the working is the circle rate or a gentry rate or a stamp duty valuation rate, which needs to be replaced for the purpose of valuation of annual property when you calculate the valuation under Rule 11 UA. Now, in case of an old companies where the lands, buildings are valued at a substantially lower rate because it was purchased many years back. But if today's value of the land is substantial, though there could be losses because of the insolvency company, but if the immovable property value is substantial, then the Rule 11 UA value will kick in. And there is no formal exemption under Section 56(2)(10) in case of change in management or a transfer of shares from one management to another management. Many a times, the shares are transferred at a token value of ₹1, and there is a capital reduction scheme or the existing share capital by virtue of approval of a resolution plan is extinguished. One question for the deliberation, and which is again for all of you to consider, is that Section 56(2)(10) provides that if the transaction happens without consideration, now can we argue that approval of a resolution plan and change in management by virtue of operation of a law under Section 30 and 31 of the IBC code, it itself is a consideration, and therefore it is for a consideration, and therefore Section 56(2)(10) will not apply. Or it is not even an inadequate consideration, because when the successful resolution applicant has submitted a resolution plan to meet the principles of IBC of going concern and maximization of the value, the 11 UA value actually may not matter at all, and that may not be relevant. But this is a very, very larger issue for debate, at least at a lower authorities, when the value of the land building particularly is substantially higher, which outweigh the losses or the accumulated losses in the company. The challenge would come in case of the Rule 11 UA value higher than the value at which it is actually transferred to a successful resolution applicant, which majority of the cases, or maybe in all the cases, it is at a token value of ₹1, and therefore this challenge would come as far as application of law under Section 56(2)(10) is concerned. Similarly, if I am into liquidation, or if I have a surplus assets, I go and sell, subject to approval of adjudicating authority, or I sell the business under going concern, where now Rule 11 UAE under Section 50 capital B has been introduced, which also provides the circle rate or a gentry value of the immovable property. And therefore, again, the same issue which we spoke 2 minutes back for 56(2)(10) would become relevant. That if the value of the immovable property is substantial, on a slump sale, the fair value would be 11 UAE value. And again, even if it is approved by an adjudicating authority, because you are all aware that the circle rate or gentry rate or a fair value principle under Section 50C, 50CA, 50B, 56(2)(7) to 10, all are relevant with a view to avoid any unaccounted transactions which are happening in the market. And therefore, government wanted that at least the business or the transfer of assets should happen at a fair value, which is defined under the law, which is a minimum value. And therefore, can somebody argue that if a plan is approved by a COC first, based on commercial wisdom of the COC, and then subsequently approved by an adjudicating authority, there is no question of any unaccounted money transaction, or there could not be any allegation of unaccounted money transaction. And in those situations, whether a fair value principle under the Income Tax Act should be applied, or whether itself is an adequate consideration for the purpose of transfer of assets from one person to another person. And therefore, can the government consider to give a relaxation as far as the property value or a circle rate or a Jantri value or transfer of shares under 56(2)(10) in case of companies under CIRP? And that is one issue which becomes relevant as far as the fair value principle and the transfer of assets from a corporate debtor to a successful resolution applicant is concerned. The next issue is under Section 79. As I said earlier, even under liquidation, there could be a change in management because you can sell now a going concern as a business to a potential buyer. But there is no exception given under Section 79(2) if the business is sold under liquidation. The law specifically said under a resolution plan which is approved by an adjudicating authority. And therefore, there is no resolution plan which is approved by an adjudicating authority in case of a liquidation. As per the existing liquidation rules, you have a stakeholders committee headed by the liquidator. And stakeholders committee is taken into confidence, but there is no approval of an adjudicating authority as far as the sale of an asset, sale of a business as a going concern under a liquidation. And therefore, if there is a sale of a business as a going concern under liquidation, you may not be able to avoid the implications of Section 79. And therefore, you may not be able to carry forward the losses. Now, what is an objective of 79? If I go back to the SICA Act, earlier, the objective was that loss is also an intangible asset where ultimately I would save now today 25% rate of taxation if I am allowed to get a carry forward loss, and thereby the potential buyer would be willing to pay certain additional amount. And that additional amount will go to distribute the assets in a waterfall mechanism of Section 53. And therefore, commercially, if the losses are allowed to be carried forward, the potential buyer would be willing to pay something more. And therefore, my personal view that Section 79 should be amended even in case of a liquidation situation. The only catch is that in the resolution plan which is approved by an adjudicating authority, here there is no adjudicating authority in case of a liquidation plan. And therefore, maybe a law or a regulations could be amended in both the situation, one by Section 79 and also in case of a liquidation, that if there is a sale of a business on a going concern, even under liquidation, the adjudicating authority can evaluate similar to a resolution plan and approve that business sale or a transaction so that the regulators and the government are reasonably comfortable that the process of law has been followed correctly. There is no hanky-panky. Everything has been in compliance with law. And therefore, even in case of a liquidation, the losses should be allowed to be carried forward by virtue of Section 79. The second challenge in case of a 79 is that the law provides that after giving an opportunity of being heard to a principal chief commissioner. Now the question is, at what point of time a principal chief commissioner would be given an opportunity of being heard? Because normally, when the plan is submitted to adjudicating authority by the IP after it is approved by COC, no notice is given to a tax department. And therefore, the tax department on its own may have to track about listing of a case before the NCLT, then go and tell to the NCLT that I want to be heard before the benefit of Section 79 is given. My personal view that though the law does not prescribe, similar to a merger amalgamation under section 230, that a notice has to be given to a tax department, I would believe that the IP, once the resolution plan is approved, and when there is a proposal in the resolution plan to allow carry forward of losses under section 79, the IP should give a letter to the principal chief commissioner of the corporate data that there is a plan which has been approved by COC, which is being submitted to a NCLT, and there is a proposal to allow carry forward of losses under section 79, and you may avail the opportunity being heard before the NCLT. Now, my personal experience, in majority of the cases, this does not happen. If it does not happen, and after the approval of the plan, if the benefit of section 79 is allowed by the adjudicating authority, I would believe that the successful resolution applicant should at least file a letter with the principal chief commissioner that by virtue of approval of a resolution plan, the X amount of losses of corporate data will be allowed to be carried forward to the new management. And that also would be reflected in the next year tax return, tax audit report, and other filings with the tax department. And then he can claim that carry forward of losses. But the earlier approach of intimating would be in spirit of a law, and therefore it would govern the principles of law of giving an appropriate opportunity to the principal chief commissioner. But if that is not happening, then at least an intimation would help subsequently when that losses are allowed to be is claimed as carry forward. And when you set off that losses, at least the department would be aware about your approval of a resolution plan by the adjudicating authority. The next is section 72 capital A on merger and amalgamation. You are all aware that under section 72A, if there is an industrial undertaking and if there is a merger of two companies, then unabsorbed losses and unabsorbed depreciation of the amalgamating company is allowed to be carried forward to an amalgamated company. The question is, what is industrial undertaking? As per established principles of law and as per judicial decisions, industrial undertaking would mean a company which is in the business of manufacturing of goods. What is manufacture is also defined in section 2. And therefore, we are not going into to understand what is manufacture. There is a reasonable judicial precedence on what is manufacture. And therefore, if there is an industrial undertaking, then only the benefit of section 72A in relation to merger and amalgamation is available. And therefore, if there is an insolvency company which is into financial sector, like what is happening in a Reliance Capital or what is happening in a DHFL or what is happening in ILFS, not ILFS, or a SHRE, then in those cases, the benefit of section 72 may not be available even to a companies under IBC for which resolution plan is approved. And therefore, this is one change which government should consider, that for companies which are under IBC, at least the definition of the company should be expanded from industrial undertaking to any other sectors which are approved by the adjudicating authority. The second issue is about compliance of certain conditions under section 72A and rule 9C, which is prescribed under section 72A. One of the conditions is that 3/4 value of assets should continue to be held by an amalgamated company post-amalgamation. Now, in practical situation, what happens when the company is taken over by the successful resolution applicant? He merges that company with its own company. He may not like to continue with certain surplus assets. He would like to bring efficiency in the operations. He may like to replace the assets with a better technology, with an improved technology, with a less complicated assets. Or if there are surplus assets, he may like to sell it off and realize that money for the purpose of running the new company in a more efficient manner. But in case of a company which is under IBC and where it is merged with the another company, you will have to continue 3/4 value of assets for a minimum period of 5 years, which again a condition is not commercially, may or may not be viable. I'm not saying that this may not be viable in every case, but in majority of the cases where the companies are under IBC, by experience, we are aware that this condition may not be viable to implement or to continue for the purpose of carry forward of losses. The second condition is that out of installed capacity, minimum 50% production should be achieved in 5 years. Now, again, we all know that one of the major reasons for companies going into IBC is overcapacity. His installed capacity could be 100 metric tons, and my actual business in the market is not more than 20 tons. And therefore, I may only manufacture 20 tons of goods, which is not 50% of the goods, and I should achieve that 50% in minimum 5 years. Again, I may or may not be able to achieve that capacity of production under Section 72A, read with Rule 9C. And therefore, this again is one practical challenge for the purpose of companies to implement when companies are taken over through a CRP process under IBC. So there also, the government should consider to relax certain conditions as far as the merger and amalgamation is concerned. Normally, by experience, the demerger may not happen. But when you take over a particular company and it has certain investments into another company, and that another company is not under IBC, one may not like to continue those investments to other company because it does not meet your business requirement or a commercial requirement. Now, if that other company is making a substantial profit and its value is substantially higher under 11 UA, then you may actually go and end up in making a profit. So one of the options is to sell off, where you pay a capital gain. But the other option is the demerger of the investment. Now the question is that under Section 219AA, whether our investment undertaking would meet the definition of the business undertaking under 219AA, read with Section 47. And this is one practical challenge, that when you want to divest or transfer the surplus investments into a business which is taken over, you may not be able to do it through a demerger, because there are practical challenges on demerger of an investment undertaking. It may not meet the test of business undertaking under 219AA. The other test of 219AA is also a going concern. And therefore, more likely than not, the principles of business undertaking may not be able to meet under 219AA. And therefore, the transfer of an investment or a surplus assets, which are forming part of an investment undertaking, one may only have to sell, and there you may have to pay a capital gain tax. So your cost of acquisition of a business may also include an incidental cost of capital gain, which you may have to pay to sell off certain assets. The next issue, before I go to 115 JB and 28.4, let me take up certain smaller issues, and then we will go to 115 JB and 28.4. Section 281. Normally, Section 281 provides that whenever shares or a property or an assets are transferred, normally the buyer would expect a certificate from a tax department at 281 that it is not a fraudulent transaction. Now, if the IP has already filed an application for under PUEF transaction before the NCLT, preferential, undervalued, and extorted and fraudulent transaction application, then one may worry that whether the PUEF transaction would also affect this transfer of a property, transfer of a business, transfer of a shares to a successful resolution applicant. And therefore, one may like to get a safety from an income tax department under Section 281. Two practical questions. One, if there are already outstanding demands, then the income tax department may or may not be willing to give that certificate. Even after approval of a resolution plan, as I said, the tax department may have to write off under section 156A the demands which are not recoverable. And then maybe you give a 281 certificate. But those all actions will happen after the resolution plan is approved. And therefore, obtaining a certificate under 281 from a timing perspective and from a underground reality perspective is become sometimes a difficult. The only supportive argument is that when a plan is approved by COC, when a plan is subsequently approved by an adjudicating authority, the tainted fraud or a tainted irregularity of the transaction is taken away. Because if the adjudicating authority, which is the judges, have approved a particular plan, then the chances of or an allegation of a fraud is very, very remote, or I would say nil chances. And therefore, in those situations, one can defend that it was through a process of law, and therefore the allegation of a fraudulent transaction under 281 may not arise, and therefore if any, the liability under 281 also may not arise on the successful resolution applicant. Many a times, unsecured loans or the secured loans of the bankers are converted into an equity or a preference shares by part of the restructuring plan as a part of the resolution plan. And those preference shares are redeemable over a period of next 2 years, 5 years, 7 years, depending upon the business cash flow. The question is that whether conversion of this loan into equity would be hit by the definition of a transfer. Section 47, Roman 10, only talks about bonds, debentures, etc. It does not take into account a loan. But at the same time, I would personally believe that instead of using a terminology that you are converting a loan equity, you are actually allotting the shares against unsecured or a secure loan of the bankers. Section 62 does cover a situation of the Companies Act about conversion of a secured loans into equity. Normally, as a part of the sanction letter from the bank, there is always a condition about a right to convert and secure loan into equity. And therefore, if in those situations, I would believe that tax should not have an impact. It is more about allotment of shares or a conversion of a loan into equity, more of through a right issue shares or a preferential issue shares to a bank at a fair value rather than a converting a loan. And therefore, I would believe that there would not be any implication of section 45 read with section 47. Section 148 notices. Now, this is one larger challenge today for every resolution which are approved by the adjudicating authority and where subsequently notices under section 148 are issued. Now, there are two situations, or maybe 3 situations. Situation number 1, that before the company went into IBC, a case was already reopened. The demand was raised, which is pending before CIT appeals. And say, for example, you had a demand of 100 rupees and you agree to pay part 10 rupees as a part of an operational creditors. And you go and pay 10 rupees, the balance 90 would get extinguished by operation of a law. I don't see a challenge as far as this situation is concerned. The second situation, a company goes into IBC, say for example, from 1st January 23. On 31st March 23, a notice under section 148 is issued, along with an order under section 148 capital D. The resolution plan is approved in the month of July 23. Appeal is already filed. I'm sorry, the proceedings are on. the successful resolution applicant will have to undertake the proceedings under the 148 notice where the assessment would take place, and ultimately officer may raise a demand, say for example, in March 24. And the question is that whether a successful resolution applicant will be obliged to pay this demand, or can he argue that all liabilities prior to approval of a resolution plan would get extinguished. In the third situation, that after July 23, when the plan is already approved, in the month of March 24, a new notice under section 148 read with 148A capital A clause D order is passed. Say for example, for assessment year 18-19. And then there is an allegation about unsecured loan under section 68. There are allegations about certain accommodation entries. There are allegations against certain bogus purchases. And all these issues come up to a successful resolution applicant in March 24. What happens to those notices? As I said, the Supreme Court in Ghanshyam Mishra has taken a view that all liabilities which accrue prior to the approval of a resolution plan will get extinguished. And with your permission, I'll just read 2 lines of Supreme Court judgment, para 140. We hold and declare that the respondents are not entitled to recover any claims or claims of any debt owed to them from the corporate debtor accruing prior to the transfer date. Transfer date is a date on which the resolution plan is approved by the adjudicating authority. Needless to state, consequences thereof shall follow. What is meant by accruing prior to the transfer date? In the second observation, which also Supreme Court made, that when a successful resolution applicant takes over the business, he is expected to do the take over the business as a clean slate. He should not be burdened with the past liabilities in case of the corporate debtor. Because if he is burdened with the past liabilities of the corporate debtor, then he would not be able to run the business efficiently. And if he is not able to run the business efficiently, then he would be saddled with many other challenges of the business. And therefore, he is taking over the business as a clean slate. Now, these 2 principles of taking over the business as a clean slate and the any liability accruing prior to the transfer date, how do I reconcile these 2 situations? One view, if I only read para 140, that the second situation where the notice was issued in March 23 and the demand arose after July 23, after the approval of the resolution plan, the liability did not accrue prior to the approval of a resolution plan. It has accrued post approval of a resolution plan. Similarly, in situation 3, the new notice in March 24, the liability will accrue post approval of a resolution plan. And therefore, on the date on which the resolution plan was approved, it was more like a contingent liability. It was not a crystallized liability. It was more like a probable liabilities. And therefore, those liabilities which has accrued prior to, post approval of a resolution plan does not get extinguished by virtue of para 140 of the Supreme Court judgment of Ghanshyam Mishra. The alternative argument that the Banking Law Reforms Committee report, the Supreme Court in Ghanshyam Mishra also observes that I should get a clean slate of the business. And if I need to take the business on a clean slate, then all liabilities in relation to the years prior to approval of a resolution plan should also get extinguished. In other words, the situation 2 and even situation 3, where the notices were issued subsequent to the approval of a resolution plan, those notices are also bad in law, in the eyes of law. Those notices also could not have been issued to a successful resolution applicant, and therefore these notices also to be struck down, and no liability should potentially arise in the case of a successful resolution applicant. Today, as we speak, there are many high courts has given a stay against 148 notices in situation 2 and situation 3. Certain high courts has taken a decision that even in those cases, the liability should not arise. But at some point of time, the matter will travel to Supreme Court, and Supreme Court will have to make will have to evaluate and ultimately judicially decide that how do I reconcile that I'm taking over the business as a clean slate versus liabilities accruing prior to the transfer date. Now, how do I reconcile these two? Do I only cover the crystallized liabilities, which is falling under situation 1, or do I also take over the contingent or probable liabilities for the years prior to the transfer date, which is an approval of a resolution plan? And therefore, all those liabilities also should not arise in case of successful resolution applicant. Now, this is one larger issue as far as 148 is concerned. The same issue would arise in case of section 263 notices. The principles would remain the same, that a crystallized versus a contingent liabilities, whether I would be protected by both or I would be protected only by the crystallized liability. But as I said, the courts have been taking a pragmatic view on the principles of clean slate, and they have been taking the decisions that even the past liabilities should not devolve on the successful resolution applicant, and therefore all years prior to a resolution approval date should not arise, and therefore all such notices of 148 or 263 should not arise. Similarly, many a times the resolution professional, because of non-cooperation of a management, non-cooperation of the finance people, non-cooperation or preparation of the financial statements in time, is not able to file return in time. And in those cases, the losses are not allowed to be carried forward because of section 80 of the Income Tax Act. He may have to file an application under section 1192 and pray for a genuine hardship because of the situation. And I would believe that the appropriate income tax authority, based on the delegated legislation, would grant an extension of time for the purpose of carry forward of losses, and those losses should be allowed to be carried forward. For any reason, if the appropriate authority under section 1192 do not take a favorable view, then the only option is to challenge that before the court of law under Article 226, and then pray for the extension of time and allowing the carry forward of losses as far as companies which are under IBC, because this is a very, very common situation, particularly because of lack of preparation of the financial statements in time. I have seen that many IP file return based on provisional accounts, and subsequently the return is revised based on the audited accounts, which is not a bad approach on a practical front. But ultimately, today we are all aware that even the revision of a return, there is a very, very limited window between the original date of filing and the date on which you can revise the return. and therefore the time is very short. In those limited months, one may not be able to prepare the audited financial statements, and therefore one will have to take a practical situation and at least file the return in time so that the appropriate losses are allowed to be carried forward. But I would believe that for any reason, if it is not done, then by making an application under Section 119, one should be able to claim carry forward of losses by taking an appropriate steps under the Income Tax Act. Let me go back to 115 JB and 28.4. Section 115 JB, which is now not much relevant because of the 25% taxes, and majority of the companies now may not have accumulated MAT credit. But let's discuss the concepts and principles so that for an academic discussion, at least we understand the law. Whenever there is a waiver of the principal amount of a bank loan, or the interest amount, or the operational creditors waiver, from an accounting principle, both under IGAAP and Ind AS, all waivers, including the principal amount, will have to be routed through profit and loss account. I know in the past, many people have not routed this amount to profit and loss account and have credited straight to capital reserve and then avoided the MAT liability. And we have a Supreme Court judgment of Apollo Tyres, that Supreme Court in Apollo Tyres says that the books of accounts cannot be disturbed by the tax officer if it is in compliance with an auditing or accounting standards. I would believe personally that crediting such waiver to capital reserve is not a correct accounting principle. The correct accounting principle would be to route through profit and loss account only. And therefore, if I had an outstanding debt of 100, and if ultimately I pay to a banker 50 rupees, then the 50 rupees of principal plus 20 rupees of accumulated interest plus operational creditors will have to be returned back to profit and loss account. The question is, do I pay minimum alternate tax on these amounts which are credited to profit and loss account? Now, before I answer this, many times, and which is what the argument of the government is, that many IBC companies which are under IBC have certain fictitious debtors, have certain fictitious loans, have certain fictitious advances, have certain fictitious fixed assets. Now, if I write it off, those assets, those debtors, those advances, those loans, in the year in which I take over as a company, and at the same time, I have a credit of waiver of principal amount of loan, interest and operational creditors. In realistic approach, I may not face a challenge because I have a credit amounts and I have a debit amounts which almost matches. Therefore, I may not have a challenge. But if I make a provision, because I don't know on the date on which the financial statements are drawn up after the acquisition, I may on a conservative basis provide for or impair the assets. Now, provision for diminution in the value of asset is not allowed as a deduction for the purpose of MAT. And therefore, the right approach would be to write off such fictitious assets which are lying in the balance sheet as a part of the cleaning up exercise, and then evaluate that whether after writing back of loans and writing off of fictitious assets, do I still have profitability in the books of accounts? If after doing both, I still have a surplus profit because of waiver of a loan, one straightforward answer is that I may have to pay a tax MAT. But at the same time, there are certain judicial views, particularly the Jindal case in the case of a Bombay tribunal, has taken a view that if a particular item is not an income within the meaning of Income Tax Act, though it may be credited to profit and loss account, it may not be subject to a book profit. And therefore, again, we will go back to 28(4), that whether a waiver of a loan is an income or not. If it is an income, then by going by the judicial view, it is also subject to book profit, and I may have to pay tax under MAT. But if it is not an income, then I may not be required to pay tax based on certain judicial opinion. The second argument is that Section 115 JB provides the book profit means the profit is disclosed by the financial statements prepared in compliance with applicable accounting standards, subject to certain adjustments. There is no such adjustment for such item. But at the same time, Section 115 JB subsection 4 also provides that subject to other provisions of this Act, and that subject to other provisions of this Act would mean what the tribunal has taken a view, that if it is not an income within the meaning of Income Tax Act, then such credit in the profit loss account also should not be taxable as or is required to be taken into consideration for the purpose of calculation of a book profit. But this is one large litigative view. But as I said, it is less relevant now because of Section 115 BAB rate of taxation of 22%, where certain majority of the companies are now traveled to a new regime of taxation, and therefore this may not be relevant. The second issue in MAT is you are allowed to reduce your book profit by lower of loss or depreciation. In case of non-manufacturing company, you may not have a substantial depreciation. And therefore, if the depreciation is, say, for example, ₹1 and losses are 100, you are only allowed to reduce ₹1 and not 100. And therefore, if in those companies where depreciation is very, very negligible, you again face a challenge that you credit amount of waiver to profit and loss account, but you may not get either an adjustment of write-off of assets or lower of loss or depreciation, where the depreciation is very, very negligible. So this is another challenge in case of lower of loss or depreciation while computing the book profit under Section 115 JB. The third situation is in case of a company under liquidation. Today, we do not have any formal clarity from any regulator, including the institute, that do we need to prepare a financial statements under the Companies Act, or do I only need to prepare a liquidator's account? Because under IBC and the liquidation rules, I only need to file receipt and payment account under liquidation, which is almost similar to a liquidation account under the old Companies Act when company was under voluntary liquidation. Now the question is, say for example, a company went into liquidation on 1st of April 23. I will prepare financial statements up to 31st March 23, file with MCA, file with income tax, file with GST and everybody. What happens after 1st April 20? Do I need to prepare financial statements? Do I need to get it signed by the auditors? And therefore, it is also subject to a minimum alternate tax provisions. If there is no requirement to maintain books of accounts, then the applicability of MAT automatically will not be there. My personal view, there is no formal exemption from preparation of a financial statements under liquidation. This is a liquidation where the scope has been increased substantially by regulators, including a going concern under sale of a business. And therefore, I will personally believe that company may have to prepare financial statements, get it audited, filing of a receipt and payment with the adjudicating authority by the liquidator is only to understand the receipt of amount and use of that on a cash flow perspective. But I would believe that there is a formal exemption from preparation of a financial statements under IBC or under Companies Act. And therefore, one would have to continue to prepare financial statements even under liquidation, get it audited, and if it is prepared in compliance with law, audited statements, it are filed along with income tax return, one may have to also evaluate a minimum alternate tax liability if it is subject to, if it has not opted 115 BAB. But if it has opted 115 BAB, then the question of MAT may not arise at all. Let me go to 28.4 and 194R. One second, I just had a glass of water. Section 28.4 provides that any benefits or perquisites arising in the course of business, whether convertible into money or not. So the first is, what is benefits, what is perquisites, and arising in the course of business. Let's take a simple example. I go to a petrol pump, use a credit card, and 200 points are credited to my account. Is it a benefit or a perquisite? The answer is simple, yes. But is it arising in the course of business? The answer is no. Because I am a consumer. I am not carrying on the business. And therefore, it has not arisen in the course of business. And therefore, 28.4 may not apply. But I am a professional. And my client sponsors my trip to Europe for a vacation for some good judgment I could get for him. Is it a benefit or a perquisite? Answer is yes. Is it arising in the course of business? Answer is yes. And therefore, it would get taxable under 28.4. The question was that such benefit or perquisite in the course of business, whether convertible into money or not, would it include the benefit or perquisite in cash? Series of judgments has taken a view, including settled by a Supreme Court in Mahindra and Mahindra, 404 ITR page 1, that any benefit or perquisite which is in cash is not covered under 28.4. Section 41(1) would arise only if there is a claim in the past which has been allowed and there is a subsequent remission or cessation of a liability. So if I have borrowed money from X, I have paid interest on that, I have claimed interest on that, allowed deductions under 36(1)(3), and subsequently there is a remission or a cessation of that interest liability because I could not pay to them, that interest would be a 41(1) receipt and would become taxable. Similarly, all operational creditors, I purchase these goods, I purchase these services, I have to pay to employees, I have to pay to suppliers, and my liability is 100 rupees. Ultimately, I only pay 10 rupees. The balance 90 will become remission or a cessation of a liability under 41(1). And therefore, all operational creditors, liability which are returned back to profit and loss account would become taxable under 41(1). There is no question of 28(4) in that situation. But what happens to waiver of principal amount of a loan, interest amount, and unsecured loan taken from certain private parties or including an NBFCs? As far as interest is concerned, it would be governed by section 43B. Because when I used to provide that interest to profit and loss account, and if I would have claimed under 43B, because I have paid that interest to a bank, then subsequent remission would become a liability under 41(1), and there is no much dispute about that. But if I have not claimed under 43B, then the subsequent remission or a cessation would not become taxable, even under 41(1), because I have not claimed, I have not allowed, the department has not allowed the claim, and therefore that also would not be taxable as far as the 41(1) is concerned. As far as unsecured loans, which are principal amount from NBFC or a private parties, or from a bank which is secure, the waiver of a loan is a larger issue. There was a judgment of a Madras High Court, which is coincidentally referred by the CBDT in 194 First Circular, Ramayan Nam Homes Private Limited, where the Madras High Court took a view that his waiver of principal amount is a revenue receipt taxable under 28(4). And why this view was taken? There is an old judgment of Supreme Court in TDS Iyengar Sundaram, where company TDS used to take distributors' deposit. And after a few years, if the distributors run away or distributors are not working with the company, the deposits are forfeited. The question was that whether a forfeiture of a trade deposits amounts to a revenue receipt or a capital receipt. The SSC argument that it was a liability, it was never claimed as a deduction under 41(1), and therefore subsequent write back or a forfeiture should not create a taxability. The Supreme Court did not agree with this submission, and Supreme Court took a view that forfeiture of or a write back of a trade deposit, which is obtained in the course of business, is a trading receipt, and such waiver or a forfeiture of a trading receipt is an income in the nature of revenue, and therefore it is taxable. And therefore the Madras High Court took a view that waiver of a principal amount of loan, either term loan or a working capital, both are taxable as revenue receipt. There is a second category of judgment which had taken a view that the waiver of a principal amount of loan does not arise under 28(4) because such waiver is in cash by passing an accounting entry, and therefore this is not covered under 28(4), and therefore it is not covered under 41(1), and therefore it is not taxable. The Gujarat High Court in Chetan Chemicals had taken a similar view about write back of an unsecured loan from a private party, and High Court went to further to state that it is neither 28(4) for two reasons. One, it is not received in cash. It is received in cash. And second, the SSE is not in the business of giving and lending money, and therefore it is not arising in the course of business, and therefore it is not taxable. The Bombay High Court has been consistent on a similar view. The Delhi High Court found a via media between Madras and Bombay and said that a term loan for a capital asset, it is a capital receipt, but working capital is on revenue account because I have used that money for the purpose of my running business, and therefore following the TDS principle, the Delhi High Court took a view that working capital loans are taxable, term loans are not taxable. The matter ultimately went up to Supreme Court. Supreme Court in Mahindra finally settled the controversy, overruled the Delhi and Madras High Court judgment, and have confirmed the Bombay High Court judgment to say that the right back of a principal amount or a waiver of a principal amount is arising through cash, and cash transactions are not covered under benefit of perquisite under section 28(4), and therefore such waiver would not become taxable. As I said, interest would be governed by 43B, operational creditors would be governed by 41(1), and therefore it would become taxable in majority of the situations. Principal amount of waiver because of Mahindra and Mahindra judgment should not get taxable. Now, the Finance Act 23 has amended section 28(4) and said whether in cash or otherwise. In other words, the Supreme Court judgment of Mahindra and Mahindra has been overruled to say that even a waiver of a principal amount which is in cash would also be covered by 28(4), and that would become taxable. Now there is one argument, or maybe two arguments, after the amendment of section 28(4) by virtue of Finance Act 23, which in my opinion would become relevant, and at some point of time in future, the judiciary will have to test those arguments. One, what is taxable under section 4 is the income. And if there is no income, there is no charge of Income Tax Act. Can a waiver of a principal amount, which is neither claimed as a deduction, which is neither in the form of a trading receipt, and which cannot be said a right back, is a commercial consideration out of distress situation, and therefore it is a negative benefit or a negative perquisite, and it is not a positive benefit or a positive perquisite, and therefore it should not be covered under 28(4) because it is not in the nature of income, it is not in the nature of benefit or perquisite, even if it is received in cash, and therefore one can argue that it is still not covered under 28(4). The second argument, which Gujarat High Court took in Chetan Chemicals, that I am not in the business of borrowing and lending money. So if I am not in the business of borrowing and lending money, then can I go and still argue that waiver of a principal amount of loan should not get taxed in 28(4) even after the amendment? Now the second argument would be slightly on a different footing in a financial sector company. So if I take an NBFC which is under insolvency, it has borrowed money from a scheduled bank, and ultimately that loan is written off or written back. Then again the question would arise, Vaibhav, I will close it in next 10 minutes.
Okay, sir. Understood. We have some questions. So would you like to take the questions, sir, after 10 minutes?
We'll take at 3:30.
Yeah, sure. Understood, sir.
So in those circumstances, for NBFC company, like what is going on in Reliance Capital or Shrey, where I am actually in the business of borrowing and lending, and therefore those second argument may be slightly on a weaker footing as far as financial sector companies are concerned. But I would believe that the first argument should ultimately convince the court of law in future to say that the principal amount of loan is not subject to taxation under section 28(4). A smaller issue on TDS. There was a litigation going on with NCLT and NCLAT that when I sell the property, do I need to deduct TDS under 194 IA by the buyer? The NCLAT in Om Prakash Agrawal took a view that once companies under liquidation, they are not required to file the income tax return. They are covered by section 178. They are not required to prepare financial statements. And therefore, how they would claim the refund if they're not required to file the income tax return and not required to prepare the financial statements? No TDS is required to be deducted. Now, I have my personal view, which many of you may or may not agree. One, section 178, as I said earlier, does not apply to companies under IBC because there is a specific exception carved out in section 178, subsection 6. Second, there is no exemption under section 139 for filing the tax return for a company under liquidation. And therefore, I have to file the income tax return. Third, as I said earlier, there is no clarity about preparation of financial statements. As I said, there is no exemption given under Companies Act. And therefore, going by that principle, I would still believe that the preparation of the financial statement, even for company under liquidation, would be relevant. And therefore, the company may be required to deduct the TDS. Now, this issue is arising substantially where the deposits are kept with a bank and a bank is required to deduct TDS under 194 on interest on deposits. And if any banks are facing, coincidentally, the judgment of the NCLAT has not been challenged before Honorable Supreme Court. And therefore, today, the law as stands today is the judgment of the NCLAT. And therefore, one will have to take a realistic situation as far as application of this TDS provision versus company under liquidation. As far as GST is concerned, there was a notification issued on 21st March 20, followed by a circular issued on 23rd March 20. And then there is another circular issued on 27th of December 22. If I take the last circular is similar to section 156 capital A, that once the resolution plan is approved and if the outstanding liabilities is extinguished, then necessary effect should be given in the system to reduce those tax liabilities for the liabilities which are extinguished. So it is by circular, but it is exactly similar to section 156 capital A. But as far as the notification of 2020 is concerned, March 20, the general principles are that once an IP takes over the company under CIRP, he will have to make an application for a new registration number. In the first return, he will be allowed to claim carry forward of the input tax credit under the old number, plus from the date on which application is made till the number is allowed in the first return. And then he will comply the law under the new registration number, which is under the signature of an IP, and he will do all necessary compliance. As far as the past liabilities are concerned, it will be subject to moratorium under section 14 and under NCLT judgment. And therefore, all those liabilities will get stalled, not recoverable under moratorium. And as and when the resolution plan is approved, the liability would get extinguished, and ultimately the liability to the extent the resolution plan is approved will be payable by the successful resolution applicant and the balance liability would get extinguished. Let me take 5 minutes on the Rainbow Papers. The Supreme Court in Rainbow Papers, based on Section 48 of the Gujarat Value-Added Tax, took a view that based on the language of Section 48, it has a first charge over the property, and therefore it is a secured creditors. Second, that once it is a secured creditors, when the assets are distributed under Section 53 waterfall mechanism, it would be treated as a secured creditor on par with other secured creditors after the workman compensation of 24 months. Third, that the bankers who are COC members cannot take a view and cannot approve the plan which is only in their interest and not in the interest of all the stakeholders, which in my opinion is a correct observation, which Supreme Court also made similar observation in SRN Standard Chartered case. Now the question is, what about the income tax liability? In a case of Assam Company Limited, an enclave judgment, where the income tax department made certain claims, filed proof of claim in Form B, the IP did not accept those claims because appeals were pending. Ultimately, IP, I don't know how, but it's an interesting observation in the judgment that IP wrote a letter to an income tax department to say that all your liabilities will be paid off by the successful resolution applicant. He finally did not admit the liability matter travel between NCLT and NCLAT. And finally, the successful resolution applicant agreed to pay only 15%. For the balance liability, the income tax department went to the NCLT and NCLAT, and again the NCLAT has taken a view that if the IP has already confirmed that this will be paid, it will be a responsibility of the successful resolution applicant. And the matter was sent back to the NCLT for again re-adjudication. In between, after the Rainbow Papers, there was a Delhi High Court judgment of Shri Metallics, where a similar claim under Section 142 capital A of the Customs Act was made. But the Delhi High Court distinguished Section 48 of the GVAT Act and Section 142A of the Customs Act and said that the Customs Act liability would be governed by Ghanshyam Mishra and not by Rainbow Papers because the language is different, the facts are different, and therefore the Delhi High Court did not follow the Rainbow Paper judgment but followed the Ghanshyam Mishra judgment and did not accept the claims of the Customs Department as far as this is concerned. I would also like to bring to your notice about the GST. Section 82 provides that tax to be a first charge on the property, which is a similar heading of Section 48 of the GVAT Act, but a fine distinction. And I'll just read for your knowledge. Notwithstanding anything to the contrary contained in any other law for the timing in force, which is a similar first line of Section 48 of the GVAT Act. But now interesting, save as otherwise provided in insolvency bankruptcy code, any amount payable by taxable person, other person on account of tax, interest, penalty, he is liable to pay to the government shall be the first charge on the property of the such taxable person or such person. So since when the VAT was implemented, there was no IBC. But after the IBC and GST, the subsequent law, the specific reference to the insolvency bankruptcy code is there. And therefore, I would personally believe that even in GST, it would be governed by Ghanshyam Mishra and not by Rainbow Papers, because it specifically says, save as otherwise provided in the insolvency bankruptcy code. But this is a larger Pandora's box about all statutory liabilities. There is already a discussion going on in the government about changing the priority of the government dues under the insolvency code. But again, let's see what happens as far as these priorities are concerned about the statutory dues and the government dues, both under GST and income tax, because we do not have similar section under Income Tax Act. Under Income Tax Act, we only have section 179, where you can't recover from the company, you can go back to the directors in case of a private company or an unlisted company. But we don't have a similar provisions like first charge on the property. And therefore, Income Tax Act would be similar to a Customs Act, would be governed by Ghanshyam Mishra. But Rainbow is already under review. And therefore, let's see what Supreme Court decides on a review petition of the Rainbow case. Thank you very much for a patient hearing. And over to Vaibhav.
Yeah. So we have a set of questions that are coming to us. So can we have the questions, sir? Are you ready to take the questions?
Yes, sure. Go ahead.
Yeah. So probably last 5 minutes you gave to Rainbow Papers judgment, and we were having many questions coming on that aspect only. So I believe that we can avoid that set of questions, sir, because you have already covered it quite well in last 5 minutes.
Sure, no problem.
Yeah.
And if anybody still has, fine, I would try to respond to the extent possible. But anyway, you go ahead, whatever you think appropriate.
Yeah, sir. So the first question is how to calculate eligible carry forward losses or unabsorbed depreciation when the plan gets approved. So this question is in light of the facts that the tax audit report is not available with the RP because he has not been provided with the information, as it happens in many of the instances. And the other thing is that there are two figures available with the RP, one from the tax audit report and another from income tax portal. So how should we calculate the eligibility of the carry forward losses and unabsorbed depreciation?
The amount of eligible carry forward loss and depreciation would be governed by your tax return and not by a tax audit report. In tax audit report, you normally borrow the figures from your tax return. Now, if information is not available, if returns are not filed in time, then to the extent possible, you will have to draw the financial statements. If the returns are not yet filed in time, as I said in the course of lecture, that if I have a delayed return or a belated return, I may not be allowed to carry forward losses and depreciation. I may have to go back to CBDT under 119 and seek for extension and carry forward of losses. But ultimately, the figures will be captured from your tax returns because ultimate figures of allowance and disallowance, what we understand under section 28, would be governed by your tax returns.
Thank you, sir. Next question is, what is the tax implication of write-off of claims? Are those taxable? So I believe, sir, you have already covered this, but still might be the person has joined late. So this question is asked.
So in summary, after the amendment of section 28(4), whether received in money or not, prima facie, the waiver of principal amount of a loan could become taxable, subject to the arguments which I said. Interest would be governed by section 43B. Operational creditors write-off would become taxable under 41(1).
Thank you, sir. Next question is on accounting aspect, but since you have a diverse experience, sir, might be you would want to take this question. So the question is, what to do when the liabilities shown in the books of corporate debtor are not matching with the approved claim amount? What should be the treatment of differential value in the books of corporate debtor?
This liability mismatch arises even in a regular business. One will have to go back to the document. One will have to go back to the documents, understand if the supplier has made a claim of 100 rupees your liability is only 60 rupees. That 40 rupees, whether it is because of a dispute, because of certain other commercial issues, or you forgot to account for in the books of accounts. If it is an omission or a commission, it will become a prior period item. If it is a disputed liability, it may not become a prior period items. And after verification of the documents, after seeing with the other team members, after sitting with a supplier, you may agree to pay 80, you may agree to pay 100, you may agree to pay 70. So if you need to provide incremental liability, if it is an omission or a commission, it is a prior period. If it is not, then it is a current year liability.
Thank you, sir. What should be the treatment of CIRP cost paid under the resolution plan, whether it is a capital expenditure or it is a revenue expenditure?
No, I did not get you.
The question is, sir, what should be the treatment of the cost, the CIRP cost paid after the approval of resolution plan? Should it be treated as a capital expenditure or it should be treated as a revenue expenditure?
So CIRP cost would be normally a revenue expenditure because it is in connection with running of a business. So you pay fees to IP, you pay fees to lawyers, you pay fees to consultants, you pay regulatory fees, everything and everything. It is ultimately in wholly and exclusively for the purpose of business, and therefore it would be a revenue expenditure unless a specific expenditure which has been done after the approval of the CS and after following the principles of IBC. Some asset, if it is created, it could become a capital. But again, experience tells me that majority of the expenditure would be revenue. It is a revenue expenditure.
Yeah, thank you. Thank you so much, sir. Next question is capital gain on sale of asset under liquidation. Should it be treated as a liquidation expense?
This is one interesting issue, that whether a capital gain or a capital loss would be a liquidation expense. My personal view, answer would be no. But at the same time, I would not discard another view because there are good amounts of arguments that by the language of the law, the capital gain or a capital loss could be a part of a liquidation expense. But going by the spirit of the law, it is mainly in connection with managing the liquidation. It is not in connection with a transfer of an asset or a sale of an asset. And therefore, by spirit and by principles, I would believe answer is no. But I would not say that the other view is not an arguable view.
Noted, sir. Coming on to the next question. On approval of resolution plan, what happens to the previous income tax matters? Probably after lifting of moratorium.
All crystallized liabilities prior to approval of a resolution plan, subject to payment under the resolution plan, the balanced liabilities would get extinguished.
Noted, sir. Can there be income tax proceeding on a company that has been ordered liquidation by NCLT?
No,
So I believe moratorium would continue.
No, sorry, I did not get you.
Yeah, I repeat my question, sir. Can there be the income tax proceeding on company that has been ordered liquidation by the NCLT? Whether the income tax proceedings can continue when the liquidation has been ordered by the NCLT? I rephrase this question.
So again, if the company is under liquidation, the proceeds will be distributed in compliance with Section 53, and therefore the operational creditors would be almost at the fourth or fifth level in the distribution. And therefore the answer would be no, that ultimately the department is not going to get anything. The workman compensation in the initial, the CRP and the liquidation cost, and then some amount secured creditors would get. So logically answer is no.
Noted, sir. Is set off carry forward of losses allowed in case of merger of corporate debtor with the resolution applicant?
Answer is yes.
Yeah.
Subject to compliance of section 72A and subject to compliance of section 79. 79, as I said, the principal chief commissioner has an opportunity of being heard, but ultimately if the plan is approved, it will be deemed to be an approval. But section 72A will have to be complied with. Then the merger, on merger, the carry forward loss and depreciation would be allowed. So that industrial undertaking principle, continuing of 3/4 value of assets, achieving 50% of installed capacity, similar principles and conditions will have to be complied with.
Thank you, sir. Next question is, what happens to the prosecution launched against directors prior to CIRP? And he's asking this question in light of the condition that no offense stand against the corporate debtor under section 32A.
So, but if you read section 32A, it also says that all proceedings against the management will continue. It only gives you a protection to a company and not to a management.
Yeah. So another question is, under regulation 37M, sale of one or more assets of corporate debtor to one or more successful resolution applicants, how losses to be allocated? Should one take over under demerger or slum sale basis? What point one should consider?
So again, I don't have with me right now Rule 37N, but generally, sale of assets or if under Rule 37 may not meet the principles of slum sale or a demerger. Slum sale is of a business comprising of assets and liabilities on a going concern. So if the business is not sold on a going concern, which would include assets, liabilities, contract, customers, including intangibles if it is there, and it is on a going concern, it does not meet the slum sale definition. Similarly, on a demerger, it has to be a business undertaking and not individual assets. If it is individual assets, it does not meet demerger and slum sale definition. You will have to pay tax. If it is a depreciable asset under section 50, if it is a non-depreciable asset, you will pay tax under 45.
Very well noted, sir. What is the time limit for application for claiming losses? It can be claimed in return.
Losses are allowed under section 72, 8 years, but if it is a merger, then you may get a new lease of life because section 72A says that the losses of amalgamating company would become the losses of amalgamated company. And therefore, if the 4 years are already elapsed, you may get another 8 years in an amalgamated company, subject to compliance of other conditions.
Very well noted, sir. What is the treatment of return of losses when a company is purchased as a going concern under liquidation?
From a buyer perspective, he will have to do purchase price allocation, account for assets and liabilities in the books. The difference will go to intangible. It could be goodwill. It could be other intangible, depending upon the nature of business. So one will have to do purchase price allocation and then account for in the books of accounts.
Yeah, thank you, sir. So this is all that we have in the questions. There were few more questions, but I have not taken them because I believe that has all well been covered by your deliberation. So if we do not have any other things to discuss, so we may conclude this session.
Sure. Thank you very much.
Dinal sir, Vaibhav sir.
Yeah, Ishanji, over to you.
Yeah. Thank you very much, sir, Dinal sir and Vaibhav sir. The session was really informative and fruitful for the audience. Since you have taken wonderfully touch upon various aspects of taxations which are applicable on the companies under IBC, the session was not only interactive, but it was very informative. Once again, I would like to thank you, Dinesh sir and Vaibhav sir. Thank you.
Thank you.
Thank you. Thank you so much.
Thank you to all of you. Thank you.